Top 3 ETFs for 2024 and beyond. This is a video requested by a subscriber, and last week we covered our top 5 stocks for 2024, and I thought might as well cover the top 3 ETFs that I think can do fairly well heading into next year and then beyond. As always, if you are new to the channel and find this type of content valuable, be sure to hit that like and subscribe button below. It would mean a lot. I was requested if I could cover the top index funds or ETFs in all these sectors, and certainly I can't do all these sectors. That would be quite an extensive video, but I think it's better to put together a video of, I think, top 3 ETFs and really why I think you should invest in ETFs. It's not a topic I've really talked about on this channel. We usually cover individual stocks, but I think ETFs are a fairly good investment, and in my opinion, they give you an easy way of diversification. So first of all, an ETF is a basket of companies that gives you access to a range of different industries or sectors in frankly a pretty easy and cheap way. And it's especially useful if you want to invest in areas where you don't really know the industry or how to analyze it. And certainly, for example, I would do this if I was looking to invest in the healthcare space, not an area where I'm particularly good at understanding valuations or companies and really how they progress with innovation in the healthcare space. And so if I'm looking to invest in healthcare, that's how I would do it. I would pick a healthcare ETF and get my exposure in that way. It's also useful if you do become overweight a specific sector and you want to balance out your exposure across the market. And so certainly in 2023, likely you might have become overweight tech just because how hard tech has rallied. And so if you want to evenly distribute your exposure, an ETF is frankly a pretty good way to do that. Now, the second point of not picking winners and losers kind of goes hand in hand with the first point, but again, you don't have to pick a winner or a loser within an industry. For example, if you want exposure to the semiconductor stocks but don't know if Nvidia or AMD or Intel are the best pick right now, you can just buy the semiconductor ETF, ticker symbol SMH, and see gains even if one company outperforms the other in its sector. And since there's basically an ETF for everything, you can apply this across really any industry or any sector you are interested in, whether that's AI or semiconductors or financials, healthcare. If you can name it, likely there's an ETF out there. And so you don't have to worry about picking the company that will outperform the others in that space. You'll kind of see the benefit just from being invested in that sector. Now, our third point is less time commitment. So researching individual stocks frankly takes a lot of time, and chances are if you're following the channel, this is something you are interested in. But I think for the vast majority of people, going through an ETF really makes sense because frankly, they don't have the time or the interest to really sit through and read earnings reports, conference calls, investor presentations, kind of all the things that we do on this channel. Most people are not really looking to do that. And so investing in an ETF gives you the way to be passively invested in the markets while still sort of controlling where your money goes. And so in that less time commitment, you can still get fairly good exposure to the market and really pick your areas and industries where you want to be invested. And lastly, why you should be invested in ETFs is because ETFs are pretty low risk, in my opinion, largely because of that first point where you get lots of diversification, but also they not only give you the opportunity to get market returns, especially if you're in an ETF that sort of tracks an index like the NASDAQ or the S&P 500, but you can also outperform the market just by a few percentage points by placing yourself in the right industry or the right sector ETFs. And over long periods of time, those percentage points certainly do add up. And for the level of risk you take, I think ETFs are a pretty solid risk reward, especially for most investors. I think most investors that do come in and pick individual stocks and essentially pick individual winners and losers end up losing money over the longer period of time. And so if you want to stick to a low risk and see returns that are average to basically above average market returns, ETFs are a great way to do that. And so that brings me to point number 2 is why am I just sharing 3 ETFs? Why not share 10 or 20 or even 5 ETFs? And point number 1 is I don't want to be over diversified. And that's because owning more stocks than necessary can take away the impact of large stock gains, and that limits your upside. And it can even get to a point where you're not actually even keeping up with the benchmarks or indexes. And so here we talked about how ETFs can give you the edge to really beat the market average by just a few percentage points, but being over diversified, that can harm your portfolio over long periods of time where you're not even keeping up with the benchmarks. And so for example, you take Nvidia's monster gain of over, I think 200% this year. And if you own a lot of ETFs, chances are Nvidia is probably just a small portion of your portfolio, maybe even less than 1%. And so you're not really seeing its gain across your portfolio because there's just so many places your money is divided into. Keep in mind, an ETF is a basket of stocks. And so again, if you're investing in a basket, your money is being divided up into those individual companies. And again, if one rallies a lot, but your money was really split up across the board, chances are you're not seeing that gain. And that way you can really underperform the market, which is certainly something we are not trying to do. Now, point number 2 is you might as well own the S&P 500 index fund. I think the ticker is SPY. And I would say that instead of owning 10 to 20 ETFs, you're probably better off just owning a singular ETF that follows the S&P 500. That way you're at least keeping up with the markets because, you are the market. And 2, you're owning the best 500 businesses in America that have good revenues, good earnings, and strong cash flows. And so you kind of know where your money is going. It's going into the best businesses across the United States. And I think that's a great way to be invested instead of owning 10 or 20 different ETFs. Now, point number 3 is specifically for ETFs that the fees really add up. And so if you didn't know, ETFs have management fees. Usually they're pretty small, but if you own a bunch of ETFs, the fees you pay will really add up. And yeah, needless to say, that will eat into your yearly performance. That one's pretty self-explanatory. So with more ETFs, you are paying more in fees. Now, last point is there's an overlap usually between ETFs. And so lastly, if you own ETFs, chances are some of your holdings in the ETFs overlap with each other. Now, if you go industry specific, this may not be the case, but generally if you go broad-based growth or value or even dividend ETFs, there's a good chance you'll own maybe an Apple stock or a Microsoft stock in more than one place. And so if you own too many ETFs, you might not be actually reducing your risk in the way that you think you are. Chances are if you own, let's say, Apple stock in a number of ETFs, you probably own too much Apple than you really think you do. And in my opinion, I don't know if there's a right number of ETFs to own, but I would say probably 3 to 5 ETFs is right for most people. And then you could mix it up with owning some individual stocks as well, or just by adding additional industry specific ETFs on top of your 3 to 5 broad-based ETFs. And so while we don't usually talk about ETFs on this channel, I just thought I'd share my thoughts. And frankly, ETFs are a pretty solid way of getting invested in the markets, especially if you're new to the markets, or if you're maybe older and you're more in a capital preservation mode rather than capital growth mode. Yeah, you can sort of just keep up with the markets. And again, if you're very new and you don't really want to take the risk of investing in individual stocks, especially when you have a small portfolio, you want to keep your principal amount and not really lose that, as it's hard to honestly scale up your portfolio. And so ETFs are a great way to start your journey into the markets. Now, with that being said, let's share my top 3 ETFs that I think will perform fairly decently in 2024, and then I think will actually perform fairly well over the next 3 to 5 years. And ETFs certainly are a long-term position. I don't really know how many people are out there trading in and out of ETFs. I think if you're buying into an ETF, generally you're going long that industry or sector or going long the broad market. Now, the first of our 3 ETFs is the iShares Russell 2000 Growth ETF, ticker symbol IWO. This one has an expense ratio of 0.24. Generally, you'll see expense ratios, I'd say under 0.1 is pretty good. And then once you get up to 0.5, you're getting pretty high up there on the expense side. And so right in the middle at 0.24%, you do get a small 0.72% yield on this one. The iShares Russell 2000 Growth ETF, as the name suggests, tracks the Russell 2000 Small Cap Index, but focuses more on the growth side. And so it doesn't invest in all 2,000 names. If you're looking to invest in the Russell 2000 index, yeah, you're looking for ticker symbol IWM. This one focuses on the, I think, top 1,000 names that are growing the fastest within that industry, or pardon me, within that index. And so your money is split over just 1,000 names instead of 2,000 holdings. And personally, I like that. That goes back to my point of being over diversified. I think instead of being in 2,000 names, I would rather be in the top 1,000 within the Russell. And this includes names such as a Super Microcomputer and Elf Beauty. Frankly, companies that are growing at a pretty solid clip. You're not really overexposed to a single name. You see your top 10 holdings make up just 6.5% of the overall ETF. And so again, your money is split up fairly evenly. You're also not exposed to a particular sector all too much. You have 25% of the ETF within technology, another 22% in healthcare, roughly 20% in industrials, and then 10% in consumer cyclical. So pretty, I'd say, even distribution across your sectors. Again, your top 10 holdings don't make up a huge portion, and so you're not really top heavy within this ETF, which is something I personally like. And then the other reason is I think the small caps are set to, again, continue to perform well over the next, I'd say, 3 to 5 years. They really haven't performed that well over the past, I'd say, 1 to 2 years. They peaked out back in 2021 and still hasn't recovered to that level. And over the past really decade, you can call it, this has been in a steady uptrend, but like I said, has underperformed over the past 2 years, with primarily with the macro environment, with consumers struggling and the interest rate environment being so high. These small cap companies tend to be fast growing, and especially when capital is so expensive to borrow, these small cap companies tend to suffer, especially since a lot of them don't have great balance sheets. But I think with interest rates hopefully getting lowered in 2024 and then in 2025, I think small caps can once again begin to outperform the S&P 500. Again, this is something we'll have to wait and see. I do like the Russell 2000 and the small cap area generally to be in for the next 3 to 5 years. Now, ETF number 2 out of 3 is the Schwab US Dividend Equity ETF, ticker symbol SCHD. This one is basically our play on the dividend side. So we took a look at the small cap space. Now we'll try to diversify into the dividend area. This expense ratio is very low at 0.06%. So a very nice low expense ratio, and you get nearly a 3.5% yield on this one. The top 10 holdings for this equity ETF is you have Broadcom, you have Home Depot, AbbVie, Texas Instruments, Merck, Chevron, Cisco, Pepsi, Coca-Cola. And so you have a pretty diverse range, I'd say, in terms of your sector breakdown. You have some exposure to semiconductors with Broadcom and Texas Instruments. You have some healthcare exposure. You have some oil and gas exposure. You have some consumer staples with Pepsi and Coca-Cola. And so overall, your industrial breakdown is you have majority in industrials, financials, healthcare, and then tech. So pretty equal weight, I'd say, across the industries. And you're not really splitting your money up too far. You have roughly 104 holdings in this, and the top 10 make up roughly 40%. And these are pretty solid companies that have been around for a long time. And the main thing you're looking for from this ETF is dividends and dividend growth, especially. You're getting that 3.5% yield. A lot of these companies, most of these companies, pay a dividend close to at least 3%, or if not, they're growing their dividend at a pretty rapid clip. And then you're getting a dividend growth rate of, on a 3-year basis, nearly 9.5%, on a 5-year basis, closer to 13% growth per year on that dividend. And so certainly from a dividend perspective, I think this is one of the best ETFs you could own for the foreseeable future. It has a very low expense ratio, which certainly is important, especially when you're looking for that consistent dividend income. You don't want to be paying a ton in fees. And I think this does exactly that. Similar to your small caps, dividend stocks have underperformed. As you see, their returns over the last 2 years for this ETF has been basically flat. Again, a challenging macro environment, I think, is mainly to blame for this, as with higher interest rates, a lot of these companies have a ton of debt on their balance sheet, and repaying that debt becomes a lot more expensive in high interest rate environments. And so as the interest rate environment, again, hopefully increases, as consumer sentiment hopefully gets better, companies with a lot of debt on their balance sheet tend to do better. And the other thing I think that can help the dividend space is an inflow into dividend equity ETFs like this one, just because your savings accounts will probably not yield as much as 4 or 5% over the next few years. And so there's, again, going to be an inflow back into dividend equities. And while that happens, you can collect your dividends by owning some pretty solid companies like Broadcom and Home Depot, in my opinion. That was ETF number 2 of 3. Last one we are covering is the QQQM ETF, Invesco NASDAQ 100 ETF. Now, this is an ETF that basically tracks your NASDAQ 100. It has a expense ratio of 0.15%. Keep in mind, this is important. We'll get into this in just a second. And again, you get a small dividend, but you're not really buying this one for the dividend. You're buying this one for the growth. And again, keep in mind, ticker symbol QQQM. The top 10 holdings in this one are your technology staples, basically Apple, Microsoft, Amazon, Meta, Tesla, Nvidia, Google, and those make up roughly half of the ETF. As you see, majority of this ETF goes into the technology sector. 50% of it is in your tech growth names, another 15% in communication, and then so on and so forth. And so here you're basically investing in the NASDAQ 100 or US tech names, the ones that will likely continue to benefit from AI and cost cuts that they've implemented in 2023. And basically, if you were to look down the NASDAQ 100, you not only have an exposure into tech names, but you have companies like Costco and Pepsi, and again, semiconductors and other software as a service names that even in a downturn where tech names sort of tend to underperform, you have companies like a Costco and Pepsi that can help this ETF, especially when broad-based tech is experiencing a downturn. Now, there is a difference between the QQQM and the QQQ ETF. Now, if you're familiar with the Nasdaq's most popular ETF, you've probably heard of the Qs, also known as the QQQ, and there is a difference between this ETF, which is the QQQM, and the Nasdaq staple triple Q ETF. And the only difference is the expense ratio, as this Qs have an expense ratio of 0.2%, but as we saw, the QQQM has an expense ratio of 0.15%. And so a small difference, but really there's no other difference in the ETF apart from a very minute difference in liquidity. But I think for the average retail investor, that will not be noticeable. And so in my opinion, if you are looking to invest in the NASDAQ 100, the QQQM is the clear way to go instead of the Qs. This ETF is fairly new. I think it's only 3 years old and was, started back in 2020. And so you don't have really 5 or 10 years of data to look at. But outside of a lower expense ratio, there's no other difference between the QQQM and the triple Qs. And so if you're getting a lower expense ratio, I think it's a pretty big no-brainer to invest in the triple QM instead of your staple triple Qs. Again, that's coming from a perspective of you're not trading billions of dollars worth of shares in these ETFs. And so liquidity isn't really that important to you and not really even noticeable. And so that brings me to the technical analysis for this ETF. Basically follows the NASDAQ, has done extremely well over the past 1 year. Probably won't do this well in 2024, but I think that's not a reason to bet against tech, especially bet against tech that is far more efficient now, continuing to grow earnings, continuing to grow revenues, and seeing benefits from areas such as increased spending in advertising and AI. And so these companies, your Apple, Microsoft, Nvidia's, Google's, they'll continue to see benefit, and maybe they don't outperform the same way they did in 2023. I think they'll continue to do quite well over the next 3 to 5 years. And that is certainly a reason to buy the dip really in any meaningful way in the NASDAQ. And I think you'll do just fine over a long period of time. That was my take on the top 3 ETFs. I would suggest for 2024 and beyond, you have an investment into the small cap space. You have a dividend ETF with pretty solid dividend growth, and then you're betting on the best of the best companies in the tech space within the US. They have the best profits and are the most efficient companies in the world. And I think there's nothing wrong with betting on them once again. Let me know your thoughts on these ETFs in the comment section below. Also, let me know your thoughts on, do you think ETFs are a good way to invest? What is your really preferred way of investing, whether you're going individual stocks, ETFs, index funds? And let me know that in the comment section below. As always, thanks so much for listening, and I'll catch you guys in the next video.